second-class citizenship if some of these more radical types had their way. Well, that's not just polarization. That puts us in a very, very bad direction, both for the country and for American leadership around the world.
So what should his top 3 priorities be in the first 100 days?
I think it's very important to see where there are ways that Democrats and Republicans can work together. I don't know about the stimulus package and whether there are certain aspects of it that are going to be very problematic for the Republicans. Of course, the Republican Party, as everyone knows, is a party that prefers smaller government, lower taxes, less regulation. But Joe Biden is going to have to satisfy some of the more radical elements in the Democratic Party with, say, the bailout of state pension funds and also moving towards a number of climate-related regulations. So that's understandable. But the degree to which Joe Biden is able to bring Republicans to the table and say, look, we're all one country here. Let's find ways on the issues that we can perhaps compromise on to do good things for the economy, to lift up, as former Prime Minister Tony Blair just said now, to try to deal with the economic destruction of many of these misguided lockdown policies resulting from the COVID pandemic. So I think that outreach is going to be very important. And then on the Republican side, Francine, the question is, how do they respond? Because about 35 to 40% of Republicans are what I would call hardcore Trump supporters that may want no reconciliation, no unification if it means with Joe Biden. They want the Trump presidency again. That's going to be a very difficult part of the base to placate. But about 60% of Republicans who are more traditional may be seeking ways to work with Democrats. And I think we'll have a better snapshot of this, Francine, come 2022. Those will be the congressional elections, of course. And traditionally, the party out of power in the White House tends to do better. So that bodes well for the Republican Party. But depends on what Donald Trump does over the next 2 years, what the Republican leadership in the Senate and the House do over the next 2 years, how Democrats treat Republicans, and of course, how world events shape American politics.
John, thank you so much. John Steele is their Trilogy Advisors geopolitical strategist. Now, coming up, we speak to Johns Hopkins' Joshua Sharfstein to look at the vaccines. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we did have some worrying news about the vaccine and possible allergies in certain cases. So let's get an important update with Joshua Sharfstein of Johns Hopkins University. Joshua, I have a lot of questions on the vaccines, but of course, the one that's worrying the most is Norway saying that a number had allergic reactions to these vaccines. Is this normal in this point in time?
Well, we certainly know that there are allergic reactions to the vaccine in the United States. There have been about 10 million doses delivered, and the rate of a serious allergic reaction appears to be pretty low, maybe 1 in 100,000 or something like that. So, it's a possibility, but the risk of getting COVID and getting sick from COVID is far higher than that, and allergic reactions are treatable. So far it has not been a deterrent to the big vaccination campaign.
Are there other serious reactions? I know there have been a number of, very few, but still deaths. Is there anything in that the vaccine manufacturers are now saying that they could change? Or again, is it, something that unfortunately, as awful as it is, it happens?
Well, there's nothing that I know of that's actually linked to the vaccine. There are things that happen to people after vaccination just because there's so many people getting vaccinated. You're going to see things happen after the vaccination, and there are studies that are done, and I'm sure will be done if there are any signals that pop up to see whether or not, something that happened is just a coincidence or whether it's really related to the vaccine. This is standard for any large vaccination program, but at this point, I'm not aware of anything that would, it's so concerning that people are thinking about making changes, fundamental changes to the vaccination program.
Dr. Sharfstein, do we have data to know how much it reduces once you get the vaccine? How much reduces the chance of giving COVID if you catch it to someone else?
There's some signs of that data, right? So you're pointing to studies that were the basis of approval showed 95% reduction in getting sick. But in terms of what's your chance of passing it on, there'll be more extensive studies, but it looks like there is definitely some benefit, maybe, in the ballpark of half, 2/3, something like that.
Yeah. Thank you so much, Joshua Sharfstein there at Johns Hopkins.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Good morning on this Martin Luther King Day from Berlin. I'm Matt Miller. Welcome to Bloomberg Markets. Let's take a look at what's going on in the financial world right now. Of course, equity indexes will be closed and bond trading as well for the day in the United States of America. We do still have movement in other markets or U.S. assets that trade around the world. The dollar, I think, right now is the most interesting and getting the most attention. Here you can see the dollar spot index right now up a little bit. We do have the euro losing some ground against the greenback at 120, and the pound losing ground as well at 135.5. S&P futures, you can see little changed, but edging their way higher. We did have European indexes down across the board for most of the morning session. It is 1 o'clock right now in Berlin, noon in London. You can see the Stocks Europe 600, that's the broader European benchmark. Really little change as the DAX turns positive here in Germany. The CAC and the FTSE, however, are still down. And then finally, a look at Bitcoin turning around a little bit after dipping this morning. It's trading right now for $36,395, but technical traders say the charts don't look good after it hit 40,000, almost made its way back, and then came down again to this level. Now, one of our top stories this morning is the gap between America's haves and have-nots. It's widened dramatically after the pandemic demand shock triggered ultra-easy monetary policy and a follow the Fed mentality that continues driving markets higher. The central bank's toolbox proving to be ill-equipped to address the wealth gap and accommodative policies lining only the wealthiest pockets, while millions, tens of millions of people struggle to put food on their plates. Listen to Fed Chair Jay Powell weighing in.
We have been talking more and more about various kinds of inequality that have been sustained and have grown in our economy over the years. They connect directly to our maximum employment goal. So maximum employment, if you take that statutory goal seriously, it isn't achieved if there are lots of people not working around the edges of the labor market. We will continue to talk about those longer running features of the economy, and we'll continue to take them into consideration in looking at maximum employment.
Joining me now is James Athey, Standard Aberdeen Investments Senior Investment Manager. And James, I got to ask you, in humanistic terms, this is a huge problem. And actually, we see the reverberations socially have for years, but they seem to possibly be getting worse after witnessing an armed riot in Washington, D.C. A week and a half ago. What about market terms? Why isn't the market more concerned about this growing income inequality?
Oh, yeah. Good afternoon, Matt. For the reasons, really, that you've already intimated there, this all comes back to central banks and central bank policy. I'm going to strongly disagree with Chairman Powell there, because the notion that having a full employment goal justifies such extreme policy measures aimed directly at financial markets with little or no transmission to the real economy under the guise of lifting the poorest out of some of the very difficult situations that they find themselves in, I think stretches credibility to the extreme. The reality is that Wall Street and financial markets are the domain of the upper echelons of society. And therefore, this is a form of really trickle-down economics, just much more extreme and with much less effective transmission to the lower halves of the population. So to me, a healthy economy is how you raise prosperity for all, and a financialized world in which investors and even corporations believe that they can make riskless profits in financial markets regardless of the prevailing state of the economy is about as far from a healthy economy as you can get. So I think financial markets become further and further disconnected from the economy because that's where central banks push them.
Clearly, a lot of people out there agree with you, James. I mean, if you look at the Federal Reserve balance sheet, or really any of the central bank balance sheets, it's pretty spectacular to see how much debt they've taken on. If you look at fiscal government spending, it's spectacular to see, you know, not just TARP size, but double, triple, quadruple TARP size packages being spent. Nonetheless, as an investor, I guess you've got to grasp the realities of what happened. So how long can this go on?
Yeah, and that's where it becomes really difficult for an investor, because you have to recognize prevailing reality. But as a long-term investor who's looking at the fundamentals, I'm not a trader. I'm not just purely trying to attach myself to momentum. I have to understand where there is a big divergence between market pricing and underlying reality, and trying to manage risk around those situations can be painful in the short term. Successful long-term investors tend to spend a lot of their time in performance terms around the middle of the pack. If you can churn out average results year after year after year after year, you will find that over time the compounding effect of that puts you in the upper echelons. So it's not about trying to win in every market environment, win aggressively in every market environment. There are times in which you have to accept that your view disagrees with that of the market, and maybe there is some short-term pain. And recently that's been one of those times. That's been one of those times for us, for myself, whereby we can see this disconnect and we can see it building, and we can see, therefore, there's more potential energy in financial markets as they rise higher and higher without the fundamentals to justify that. And so at times you have to accept that there is too much momentum behind those market moves, get back to the sidelines, manage risk in the short term. At the moment, it's one of those times where we're just looking to build some positions around that prevailing view, which is to say we still believe that there are huge, significant challenges for economies ahead, and we believe that market pricing is complacent and euphoric in places, and that cannot continue infinitely. When that reality dawns is always difficult to say, but I would describe the early weeks of this year as being somewhat, hopeful, if you like, for that market, for that investment strategy, because I think some of the more self-serving assumptions about the market paradigm have started to collapse in on themselves, which is to say rising treasury yields, rising US equities, and a falling US dollar don't go together quite so easily. If treasury yields keep rising because there is a US positive growth shock, that tends to be supportive for the dollar. If the dollar rallies, that tends to be bad for emerging markets, and the pro-risk environment doesn't look as supportive for those cyclical strategies. So adding dollars, maybe adding a bit of duration, certainly selling some emerging market FX is how we've been playing it more recently. When the equity market wakes up to the huge challenges ahead for the US, given prevailing valuations, is a bit more difficult.
So in terms of the bond market, a lot's been made over the last week of Joe Biden's $1.9 trillion package, and the fact that he doesn't have to worry, as Bill Clinton did, for example, about the bond market. But we do see yields rising a bit, and I wonder how far do you think that can go? Bloomberg has a great story about European and especially Japanese investors just ready to feed that market with money as soon as yields get to 1.25%, 1.3%.
Yeah, there's some really interesting historical analogies with respect to what's going on at the moment. I mean, you've just described there James Carville's famous quote that he wouldn't come back as the Pope or the President or a 400 hitter, he'd come back as the bond market because you can intimidate everyone. Bond vigilantes have been crushed, really. They've been run over by the wall of liquidity that central banks have been providing for years and years and years. This is not a recent phenomenon. And so you do have less discipline in financial markets. And if there is less discipline on the actors, central banks and governments alike, then it's likely that some of these somewhat risky strategies will continue, but there will come a point where you've pushed the market too far and it will exert that discipline. What we're seeing at the moment is that also we have large pools of wealth and savings out there in the world, not necessarily in the domestic United States, but in the world, which see value in US Treasuries already and will continue to see value of Treasury yields rise higher. And that's similar to the Greenspan conundrum, where the Fed was tightening policy, but 10 years weren't moving or were even rallying because China was accumulating this huge current account surplus and it was plowing a lot of those savings back into the Treasury market. If I look around the world now, I see a lot of the economies which are deemed to have won or performed very well as a result of the virus, the pandemic, and the scenario afterwards. They're all accumulating large current account surpluses, export-driven recoveries, and even if they're diversifying some of that reserve accumulation, a lot of it, most of it will be in the US, and most of it will find its way back to the Treasury market. So there are plenty of countervailing forces. Quite where that level is, I'm not sure, but I think after hearing from Lael Brainard and Jerome Powell this last week, putting the taper chat back in the box, I do think it will be more difficult for Treasury yields to push on significantly from here in the short term.
All right, James, I guess, the interesting thing will be to see if we get inflation that kind of nullifies the possibility of a Federal Reserve put, which is the kind of thing we had in the past, if equity indexes do indeed then turn down. James Athey, great spending some time with you. Thanks so much for joining us. Aberdeen Standard Investments Manager there. Now, let's check in on the first word news. For that, we go to Leanne Gerrans in London. Leanne?
Good morning, Matt, and thank you. Joe Biden is signaling his administration will be tougher on banks. He has picked a pair of veteran regulators to lead two key Wall Street watchdogs. The former head of the Commodity Futures Trading Commission, Gary Gensler, will head the SEC. FTC member Rohit Chopra is being named to run the Consumer Financial Protection Bureau. Now, federal authorities are reportedly conducting insider threat screening on the 25,000 National Guard troops coming to Washington for the inauguration. According to the Washington Post, they are concerned about extremism among the soldiers. A number of pro-Trump rioters who stormed the Capitol turned out to have links to the military. Now in China, the economy exceeded its pre-pandemic growth rates in the fourth quarter. GDP rose 6.5% in the final quarter from a year earlier. For all of 2020, China's economy grew 2.3%. That is at a time when its major peers such as the US and Japan actually contracted. And the US and the European Union have condemned Russia's decision to detain opposition leader Alexei Navalny. Russian police took Navalny into custody when he arrived in Moscow after being treated in Germany for poisoning. Authorities say he's accused of violating the terms of a suspended sentence. Navalny is an outspoken critic of Russian President Vladimir Putin. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg Matt.
Leanne, thanks very much. Now, coming up, we're going to speak with Stephanie Kelly, also of Aberdeen Standard Investments. We just spoke with James Athey on the markets. Let's talk to Stephanie about the Biden administration's plan to deal with China. She is a senior political economist at Aberdeen. This is Bloomberg.